A new generation of European founders is quietly rejecting the old playbook, ditching big-name VCs for something radically different.
Well, okay, you seem great, but I can always talk to you in the next round. So what I will do is patchwork together a small group of more aligned firms at the first round that all bring distinct networks, to Anthony's point.
But when the runway runs short, there's a catch most founders don't see coming.
If that founder needs a proper extension of, and 80% of those microfunds don't even have a reserve, then it becomes harder.
The answer might surprise you. The smallest players in venture are rewriting the rules entirely.
So I think about the benefit of being a really small, flexible firm. I can take part, if conviction aligns, in a $500,000 pre-seed, in a multi-million seed round.
They've even invented a completely new way to price deals. No lead investor required.
Rounds that are sub 1.5 million, let's say, where there is no trad lead in place. And partly this is to do with the check size of small funds creeping up.
For solo GPs, this isn't just business strategy. It's a way of life they genuinely love.
I really enjoy the relational nature of the work. Pretty amazing and beautiful. That's my lemonade stand. I love solo GP life. It's great for me.
And the revolution is just getting started. Anyone can join.
The information is out there for angels that want it. All of it goes back to putting the work in, learning, listening, building up your reps.
How are micro VCs outmaneuvering billion-dollar funds? Why are founders choosing conviction over capital? Join us as Sarah Drinkwater and Anthony reveal the insider playbook that's reshaping European venture capital, one small fund at a time.
All right, so we just had the proponents of the behemoths on stage. Now we have the opposition, the Rebel Alliance, the two beautiful faces here. One being a newcomer finalist in this year's awards, the other one just etching out of their criteria, so sorry about that, Sarah. Both of you are doing incredible work. You also, one thing that is very symptomatic or always the case with microfunds is, and solo GP specifically, you have very active WhatsApps. And during Oliver Hollis' chat, and during this chat that we just had, the chat was on fire. We saw a screenshot of Oliver Hollis that said that being a solo GP is a lifestyle business and basically argued that you have to scale, otherwise you're ruining Europe. What's your take?
I think Oliver and I should swap hotel rooms and we'll see where the lifestyle business is. No, I guess... Okay, that sounded a little spicy up front. I guess all I mean is that if we think about what the goal of funds is, it's not about 10xing AUM, it's always about returns. And I think at this exact moment in time, there are a lot of really interesting shifts happening in the market at the earlier stages where Anthony and I invest that I think fits. It makes the case very clear for the size of funds that we have. It makes the case very clear scaling may not look like in the future the way that it did in the past. And for me, that's an amazing way of starting a conversation, is looking at this slide and saying, actually, I don't personally agree with that.
No, I totally disagree with that. I think being a solo GP is like a purest form of interest alignment in some respects, and I think it's creating a product that's complementary, but that actually founders really want. And yeah, we can talk a bit more about that as well.
Let's talk about exactly that. Why is it that you believe that a solo GP, a micro fund, is better aligned with founders, will perform better in today's market?
I mean, I think there's two ways of looking at it. Firstly, to Cambridge Associates' point, there is pretty rigorous data around fund size, ability to return the fund. But I think if you look at it from the other point of view, the European scene has matured quite a lot in the last 15 years. The best founders are always going to pick who they want. And I think all of us as angels and as I've not been a VC before, but all of us as past VCs have seen partner churn happening at larger firms. When a founder picks a solo GP, it's really about I believe very strongly in the primacy of that founder-investor relationship. When they choose me and I choose them, we get each other. And so I think there's something about the edge that small funds have. Anthony and I both have very particular value adds that we bring to founders. If you are looking for that value add, this capital becomes incredibly attractive.
It's exactly that, right? It's a sign of ecosystem maturity. More choice is better. I think there is a position for founders as they're optimizing for their ideal cap tables, to slide in a very focused value add. That's where microfunds and solo GPs come to play. I think also see this personal, which you touched upon. We're seeing more and more bloated funds. I think increasingly founders don't experience that from a lot of them. And I think the purest form of that is being a microfund or a solo GP fund. It's you're fast, you're nimble, you're as personal as it gets, right? So.
I know that oftentimes the argument is also that you have a clearer thesis, you have a clearer specialization. And that is actually not one of the things that you love to highlight the most. Can you tell us why?
Yeah, I mean, a lot of people say like Anthony's the fintech guy. Absolutely not. So for sure, I think, like for me at least, I think when you're playing at pre-seed seed is not about a narrow sector focus at all. I think it's about the people. It's about kind of focusing and finding the best entrepreneurs starting something new. I think specialization has to do with like a focused value add. So going back to that, right? So like, can you have a very sharp value add that's differentiated in the market that you're trimming, that founders look out for you for it, right? And for Rerail, that's fintech networks and know-how, right? So as I'm seeing more and more companies looking to utilize fintech, embed payments, lending, insurance as part of their business, no matter the sector they're at, they can come to me for that, right? I can help them navigate that with my network and with my know-how. So I don't believe in, at least for me, at a pre-seed on narrowing down the TAM of opportunities. I actually believe, though, you need to have a right to win. You need to be sought after for something that's very focused. And being specialized allows you to do that in a larger extent, let's say.
Yeah, I think that's that, you know, if I look at the funds that are most attractive to the founders that I work with, it really is this mix of specialism and generalism. So I always think of my thesis as being very horizontal. Like, I am obsessed with bottom-up go-to-market and helping founders with unique distribution, participation, their narrative, how they think about their work. But I keep learning that ultimately, you know, any fund has to survive various macro cycles. I've invested everywhere from you know, dev tools to crypto to consumer. You're looking for the best opportunities, you know, to build the most resilient portfolio. And I think to Anthony's point, it really is about communicating what is this fund in the market. There are so many funds now. Founders have to, you know, it has to be really clear why you have the right to win and why you're the right person to partner with them. And I think, you know, promising a very particular value add, doing what you say you will do, over communicating to the market. To me, this is just a really obvious, you know, if you're launching a new fund in 23, 24, 25, you have to have that.
I always think that micro VCs, solo GPs, you have a great, very interesting value proposition for the current fund iteration. But there is, I think, a bit of a sustainability issue. At least I see you everywhere. I see you active all the time. I've never opened my WhatsApp without you saying online, small dot. How can you make this work? How can an LP, how can a founder trust that just as soon as you made a bit of money, you've made a brand, you're either on to the next thing or you'll scale, you'll move away from the model? Because who the fuck wants to travel the world constantly when also trying to build a family?
So I was in SF last week and I had coffee with two different solo GPs that are running over $1 billion in AUM. And I'm not saying that scaling AUM is necessarily the right path for me or for any solo. But again, if you look at like an Elad Gil or a Mike Chalfin, you know, firstly, networks compound over time. Secondly, every solo GP agonizes over getting the right ops structure in place. I think, you know, you and I have talked about this. I think there are always things you do at the start of your company that over time you get smarter at. I think, you know, I still really enjoy FaceTime with founders. I personally, that's where I'm most useful to them in some ways. I don't know. I think that is the tension of being a solo, is ultimately you're all in because you have to be.
Yeah, I mean, going back to the interest alignment, I do think you need to be obsessed about what you're doing, right? It needs to be kind of like giving you energy then taking out of you, because otherwise it's not sustainable from the get-go. I think we had talked about this before. I like the analogy you had given before, which was around being a professional athlete. Like, I think very much you're in competition with yourself constantly. I think the only control variable you have, like how you allocate your time, right? You need to be kind of ruthless and iterate when it comes to that. I do think there's tips, though, like making things better. So, like, maybe kind of sharing a few of those. Like, I was thinking now doing it for the second time. I mean, I have a lot more to learn from that. But I do think, for me, there's a couple of kind of hacks to that, right? The first thing when I got set up and I would do it again was be, you know, outsource anything that's ops. Like, do that. Second would be kind of give leverage on my time. Not through kind of throwing headcount, right? I think that's the easy way. It's like you can be creative, you can leverage the ecosystem, you can leverage AI. I'm allergic against coordination costs. I think it's a vertically integrated game and you don't want to add layers to that. So I think your advantage is you have no IC, you have no internal meetings, you're sucked in, you know, and the positioning you have by being complementary to the ecosystem compounds, right? And so going back to what you said, I think you got to be obsessed, but then it's a tough game.
Well, then you're always trying to work out what is the thing you do that everything has to move the needle in terms of performance, right? You're not going to lose if you have, you know, you're not going to win purely based on good ops, but you could lose through bad ops. So you have to get that right. But I think to your point, it's a constant it's fluid. You're running a one-man business in many ways.
Let's stick on the scaling part just for a little bit, because it is typically at least interest aligned with the GP. So tell me, what are the levers that you can pull when it comes to scaling as a solo GP?
Yeah, I mean, there's many levers. I would say AUM is the last one I would pull. I think AUM does not scale very well. I think beyond a certain point, you have to start leading, and that changes the game. I mean, you make massively, right? It should be a very conscious choice. I think, it was talked about before. I think if that's your aspiration, there's ways going there, but that wouldn't be my preference. I mean, in contrast, I think if I think about myself, for example, right? The number one lever I would pull would be my fintech network. So if you think about my day-to-day, a lot of my proprietary sourcing, a lot of the way I diligence that's different to others, a lot of the support I bring to the table to the founders is that fintech network. So can I make that more scientific? Can I have someone make that a science for me? That scales everything for me. That's the first lever. The other lever I was thinking about, because there's always the personal tendency, but what if you're now 45 and you have a family and you're just alone again and you just need the resources? I think there's ways of scaling AUM that's not focused on the upfront fund. So you can capitalize on the more intimate relationship you build with the founders from the get-go, from the initial position you have, by unlocking disproportionate amounts of allocation Series B onwards. And that's a way of potentially doing a select fund, a continuation fund. I don't know what the vehicle that incarnates that, but I think there is ways you can actually scale AUM, but I wouldn't do it on the core fund itself.
Yeah, I think it's not that scale itself is necessarily bad. It's more that we now have enough data around funds that started small, had incredible results in their first couple of funds, and then over time, that becomes really hard to, the performance becomes hard to scale. And I think if I think about funds I admire, we have enough data, so often it's about them right-sizing their fund size to the point where the strategy really sings. And I think for most first funds now, you're still in the process of kind of really assessing the market and what the market right now needs. And so looking at the micro funds right now in the market, it feels clear that some will scale their AUM the Trab way, some will merge. I think it's too early to know. I certainly have a very strong point of view around where I don't want to scale the AUM dramatically. I really want to focus on mastery in this very particular domain, because it feels to me that that's where I can uniquely add value over the long term. But again, you always have to, when you're launching a new fund, and I don't love the term franchise personally. It feels to me a bit like Burger King, and that is not appealing as a GP or as a founder. Burger King, yeah. And I think the work is always how do you win with the next fund? How do you keep performance where you want it to be? And how do you optimize your time endlessly for performance versus everything else?
Sorry, one more thing. I don't think we win by 10xing AUM in Europe. I think we win by extreme performance. So
getting smarter faster.
You say that the test of a great intelligence is by having two opposing thoughts in your mind at one time. We didn't manage to have that in one panel. We managed to have it two by two next to each other. I hope you will have the intelligence to connect the dots between these two opposing views. Thank you so much.
This was their finest tower.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Welcome back to the European VC Podcast. You just listened to the big debate or the big discussion or the big group hug between Anthony, Sarah, and I, where we spoke about how we love solo GPs and why we think the micro VC model is one that is probably very well positioned to win Europe. Sarah, Anthony, welcome to yet another conversation about this where we dive a bit deeper than we made it to do on stage at the EUVC Summit.
Great. Hello. Good to be here.
Thanks for having us. Excited to be here.
So, Sarah, let me start with you. At this summit, you highlighted the appeal of small intentional funds to founders. I'd love to ask you just to elaborate a bit on how this intentionality translates into tangible benefits for the startups that you back.
Yeah, I guess as an angel, I worked with a lot of founders where I had a very particular value add. I've had this theory that the best founders will always pick who they want, and I wanted to make it really easy for them to pick me. And at the same time, what I saw in Europe in the last 5 or 6 years is a really interesting amount of team churn inside bigger firms. And so what was happening is, with common magic, when we choose to work together, when I pick a founder, when they pick me, they get me for the whole journey. And I think the benefit for founders is, firstly, you're not the lead investor. So often they can come to you and use you for things they might not take to their lead. I get used for that a lot, like how to navigate how to communicate tough news, how to manage personalities. I think founders always need help with that. But I think particularly the kind of firms that Anthony and I have, we're able to collaborate really widely. So I think about the benefit of being a really small, flexible firm. I can take part if conviction aligns in a $500,000 pre-seed, in a multi-million seed round. I love to be able to move around in that way. The goal is to build the best portfolio for my LPs and to back and support the absolute best founders that I meet. And to me, that's the benefit of a tiny firm with a very particular mandate.
Anthony, I almost felt that I was reading through your deck there because Sarah used some of the words that you usually do. Could you talk a bit about how you view this same point?
No, I mean, there's not too much to add. I think we a lot of us do it, I think, for the same and right reasons. I mean, I do believe that more choice is better for founders. I do believe, as you think about different rounds and the flexibility that we have created around our vehicles, there is always a role to play when it comes to kind of adding a specific value add to that cap table, right? So I'm a founder, I'm raising an angel round, a pre-seed round, a seed round, right? And I want to kind of, craft the best round around me. What I want is someone who's by my side, human. It's the person that I will be getting for the rest of the journey. It's someone that I can confide to on the one hand, and on the other hand, because my business does X, Y, Z, I could benefit with a specific value add, right? For Rerail, that's fintech networks, right? Or I'm monetizing with payments, I'm selling to financial services. Oh, there's a component that might kind of intersect over time in the future. I'm just seeking for talent, and like some of the deepest talent has been in fintech scale-ups. Can you be helpful with that? And so I think it's a very aligned form of coming in, not over-promising, adding a specific value add, and kind of aligning with the founders on a human level as well.
Before we hit record, we spoke a bit about the competition that you are in when you're fighting for the best allocations with founders. And part of that is, of course, the multi-stage firms, and part of it is also the seed specialized firms, but some of them have grown very big. I'd love to hear your take on this, how you view the market, how you're seeing the competition dynamics play out with founders.
What's really interesting right now is there are a few things happening at once. It feels pretty obvious to me there's this bifurcation of venture happening globally, I think, but particularly in Europe, where on the one hand, you have these large platforms that are nearly always global. They've won for a really long time. They're amazing at what they do. They have a very particular set of founder archetypes that they like. And they have the capital that really suits a certain kind of company. And certainly firms like ours, these can provide liquidity longer term, that they have a really important role to play in the scene. And at the other end, you have this really interesting, diverse wave of new managers coming up that all bring distinct networks, distinct value adds. And then you have a lot of seed firms in the middle that have grown quite big, that have distinct ownership targets where if a founder takes that firm, they're not able to bring in. So I think what you're seeing is increasingly educated founders being mindful about dilution, building at a time where some companies are always going to have distinct capital needs, but many are not. If I'm thinking about right now in terms of AI, like Cursor alone, the teams I'm backing now are smaller on average than the teams I backed 2 years ago. And the consequences for us are often the first rounds are smaller. Like I was tracking the size of my average first round in 2023 versus now. It's a little bit smaller. What I've seen happen repeatedly is a large firm with an incredible brand comes in and tries to kind of make an offer at first round where they need to put a little bit more money in to make their maths work. And the founder is like, well, okay, you seem great, but I can always talk to you in the next round. So what I will do is patchwork together a small group of more aligned firms at the first round that all bring distinct networks, to Anthony's point. What's really interesting is I always think small firms can believe where large firms can't. We can like different founder archetypes. We can just believe differently. And to me, this is kind of really where outliers are made. So, there's a bunch of right-sized winners in Europe, I think, that aren't going anywhere, but there are a lot of firms that have got big really fast. And so the maths they need to make their model work, the archetypes they're going to be looking at fundamentally are a bit different, I would argue. That's kind of a lot of things in one, but to my mind, that's kind of what's happening.
Yeah, I mean, not too much to add to that, by the way. Like the only thing I'd add is, as a micro fund, I try to get into as early as possible. It does seem to be a bifurcated type of round, right? The like, 1 to 2.5 million and the like 5 million round. And the way I see my job is like, I need to be in the best founders and market opportunities. I'll play on both sides. I'll try to get into the 5 millions earlier in angel rounds where I can. And then how that manifests itself among micro funds and competition, as I said previously, if that was part of the question, I do think that we're in the purest form of being in competition with ourselves. Like, you need to play the game so that you're there as early as possible. You need to kind of, meet those founders and develop your conviction as early as possible as well. But I do believe in the end of the day, like if it's a round that's syndicated by micro funds, which is something we're seeing now, there's a lot that can be in. If it's like led by a seed fund, usually they take 40 to 60% of a round. So there's space left for me and Sarah and angels, right? And if it's led by a multistage, I think that's where it gets a bit more squeezed. That's where I think I, by myself, will be very selective on some that I do because of the economics of the round themselves. But there, I would also mostly do when I would have known the founders from before, right? I would have tried to do an angel round. And so if I'm obsessed about it, then there's, competition, right? Because a multi-stage would usually take 80% of a round. There's 20% left. Maybe it's just angels. Maybe it's one micro fund. So like bottoms up, how this ends up creating competition among micro funds depending on who leads, right? But I think on the other extreme, which I mentioned before, like it's really fun to start seeing, some syndicated rounds from micro funds as well, which is something I think we didn't have in Europe at all, like maybe a year or two ago.
No, I think that's so true. And I think what's really interesting to me is kind of like, if we look at the volume of small funds on the market now, like right now, everything feels really collaborative. I do keep looking ahead a couple of years' time and being like, okay, most small funds, I think in 2025, very hard to launch a fund without a very distinct set of networks, a very distinct kind of value add. Anthony, you and I have this in spades, but I think what's really interesting is looking at the kind of deals certain funds are doing. And I think fundraising is always a game of haves and have-nots. That's always been the case. But at the same time, there are certain kinds of rounds now that are happening really fast. And this is an absolute benefit. Being solo is ultimately you're working on your own. You can totally clear your calendar and kind of build conviction incredibly fast. At a time when I think much larger firms are still going through the motions of building consensus internally, I think that, again, is a benefit of a tiny firm. Obviously, the big funds are incredibly good at this too. But I think the best founders will still continue to have incredible choice. And we need to continue to work to make it very easy for them to see the benefits of really tiny firms.
Staying on this point of competition between funds, I think there are two things we should talk about. There's the Headless Rounds, which we didn't make it to talk much about. And then there's the phenomenon you just described, Anthony, of micro funds syndicating together to then lead a round or make the round entirely happen between them. If we start on the latter, because you brought it up just before, can you talk a bit about how you make this work as a community of micro funds, so to say, why it's starting to work now more than it did earlier, kind of talking to the inflection point / development point we're at?
I guess micro funds inherently, we share a lot with each other, no? I mean, as I said before, like it's the least kind of direct competition way of being. And so as with everyone, I do get like the weekly update from X micro fund of like, what's the most interesting things they've done, blah, blah, blah. So I think there's a higher tendency for collaboration. There's a higher tendency for sharing. There's a higher tendency for sharing also layer deeper on like conviction building sometimes. And so I do think that like that organically creates dynamics where sometimes, micro funds are looking at stuff together. Now, I haven't seen too many, but the few that I have seen tend to have been things like, a founder before they even started raising, or a founder thinking about doing a friends and family round, or a founder looking to do a very small pre-seed round. And then suddenly it's ended up becoming one or two micro funds getting like really excited really fast, which is what you need to do as a micro fund. And then just like trying to close the deal before it actually becomes a larger round, right? Or a friends and family round where the founder gets allured by one micro fund that gets connected to another micro fund. And before they know it, it becomes a slightly larger round that's actually kind of being done by micro funds. Now, the why now versus not earlier, I think it's like critical mass of like micro funds. So I think it's maturity of the ecosystem. So I wouldn't say anything sophisticated there. I would caveat that although I'm a firm proponent of this as a phenomenon, because I think it obviously amplifies how, because a lot of people have this idea that like, micro funds are there to just be tag along funds, they're hobbyists, they just chill. It's the opposite, right? So it's like they find things sometimes earlier than anyone else. They build their own conviction. They just want to back founders. And sometimes actually like they do it even before anyone else does it. So in its purest form, I like that notion. I must say though, similar to just doing angel rounds, etc., where you can be allured to the high quality founders but lower valuations, I always try to be cautious to do it in founders and categories where it makes sense. Meaning, the higher the fundraise risk, the higher the capital requirements, the more the complexity, the lower the experience of the founder having been an operator before or a second-time founder, the more I get a bit more nervous on the like, but what if they need that extension? What if they need a bit more of that? And that doesn't mean that I wouldn't do it. It's just like another factor, right? So like where you have vertical AI stuff, where you have horizontal AI, like things that are a bit more capital light, founders that know the space really well, and they can learn really fast, and you feel confident of that, or maybe market pool that's illustrated, the more I'd feel like, okay, we got this, right? Because the thing that I think, maybe it's an essence, but the thing I think can be a bit harder if you have a panel of just microfunds is, if that founder needs a proper extension of, and 80% of those microfunds don't even have a reserve because that's their model, and the others do for like very selective deals, then it becomes harder. Now, counter to that is the microfunds will get closer to the founders, and they'll hack it and they'll find the money somewhere because they'll go to the end of the world to help those founders. But I think that's the caveat that have. It's similar with angel rounds. When I try to manufacture an angel round, I'll be like, well, if it's the regulated capital intensive kind of business, if this is a very green founder and the learning curve, I don't know. If not, absolutely.
Yeah, I think that's totally right. The last kind of syndicated microfund round that I worked on was someone that had been a founder before, basically didn't run a public raise, and everyone that spoke, it was like a week where he went to a couple of friends and was like, hey, I'm going to do a first round for this thing. And because of the kind of company, because of his experience, it just worked in that particular dynamic. But I think to a point, this piece around reserves is actually really important in terms of, like, I love the headless rounds. I'm very much a fan of that term. But to your point, Anthony, there are situations in which, particularly now, where the metrics to every round have moved. And so easier to build products than ever, harder than ever to build moats, lots of companies in Europe with insane ARR growth. And so when you're thinking about what's happening at seed and A, you always have to be thinking ahead of the first round of like, okay, what is the kind of fundraising story of this company? What do they need to prove? Where does that capital come from if we don't get there? There are just so many more dynamics to consider versus a kind of much larger first round, which I think can be difficult in terms of giving the founder too much time, but pros and cons, I guess.
I just wanted to ask a bit about the dynamic of this, let's call it Dirty Dozen or whatever, the group of solo GPs that come together. How do these rounds come together normally? Do you believe that there's a good point in being locally specialized as a micro VC, and for that reason, also when you end up syndicating, it's often that there's a local lead or a local champion for a specific deal within the group of solo GPs. Similarly with specialists, you both have your specialty, the two of you, and then it's typically that way that it forms. And how much, and honestly, as an angel, you oftentimes lend a lot of decision making and diligence power and so on with the lead. Is this also what happens between these funds, or do you maintain as diligent as process? And I know what you'd say on a public podcast like this one, but what in fact is what's happening?
It's so fluid. I mean, as with any field, you have people that you deeply trust. Ultimately it's my fund. I'm stewarding LP capital. You're still doing your own process. You're still doing your own references. You're still trying to understand a market in motion or an emergent, because I specialize in kind of bottom-up go-to-market and narrative, that's the piece that I'm always most interested in, of like the selling of the thing. But I've made investments in the last year in kind of egg packing factories and, like the egg packing robots and factories. And so again, for that particular kind of investment, you're going to have to go and do some work on it and work out who. And so obviously you're communicating and coordinating with co-investors in tiny funds, and maybe you're sharing information, but you're not, and you can tag team on diligence, but at the same time, you may come to the totally different conclusion. To me, conviction is quite a personal thing. I'm just thinking of like the most challenging angel investment I ever made. The one that I learned I regretted was something I said yes to on December 24th, 2020, where a friend had already invested and was like, oh, this is so your kind of company. And it turns out me and the founder in time were not a great fit. If I'd have had more time, if I'd been more experienced. But, I think that was a really big lesson for me. As an angel, it's your money, so you can do that kind of thing. As a fund, I do not think it would be smart to YOLO into things in that way. And I'm not saying it can't work, but I'm saying particularly if you're kind of building the structure and the muscle of conviction, even in a fund with 32 bets, that's not the right way to work, for me at least.
No, I totally agree. I will also add, which might be quite obvious, not only phenomenally syndicated rounds, right? So like now increasingly some of the rounds and companies that have been pulled in lately have been, an insider round after like a pre-seed that's kind of like topping up because it's doing really well, but they want to add a fintech angle to it, or a round that's like, closing, but they have this 50K left, and like actually because they want fintech network, they will kind of extend it to like 400K and try to get me in. These are all, not the ideal situations in terms of like, I haven't met that founder super early. I haven't like, built that relationship. And then you feel awkward because like they're closing in the end of the week, or they're supposed to close in the end of the week. You have the lead VC that might have introduced you as well. And you're like, oh my God, like I feel, but these are, I think, the biggest temptations when you're like, okay, I should just like feel like X fund is doing it, and I did a call with the founder and the team is great, we should do it. I absolutely don't do that. I actually am very upfront. I'm like, look, because of the dynamic and the category, I really love this, but I will need X amount of time, and I'll try to do it as fast as possible and as least touch points from you as possible. Meaning like we'll do like, couple sessions, but like they'll be very high impact. But it's so important to kind of develop your own conviction, not be pulled into that. And I think a microfund type of round potentially has a more tendency of that happening because we all kind of, share with each other. And I think the other point that you made, Sarah, that's I think very true, at least also was very true to me, is it's a system, like conviction for me is like a complicated system between like an emotional initial trigger needs kind of like a rational way of processing and then an emotional decision. And so like, I think the two emotional sides are informed by the rational, but the way people like assign implicit biases, weights to like the different risks and all of that underneath that mental model is very different. And so like, I'd welcome like data points if like Sarah's done customer work and industry work. And I also welcome her opinion about it. And then I'll factor that into my decision. And it's not whether I discount her opinion or not. It's more about like, what does that do into my mental model underneath towards like my conviction building? I think it's more complicated than like, herd mentality or not, or, just coming in because others are doing it or not.
Well, and something that I always really appreciate, and I tend to find that micro funds do this a little bit more than bigger firms, because bigger firms can always do the next round, is when you send something promising that you have conviction into a micro fund friend, and they come back, they go through their process and they come back with like really interesting feedback around things to think about. And nearly always that helps me help the founder, because nearly always it's great. It's a reason why this wasn't for them. And I think, everyone has their own mental models, their own systems. It doesn't affect your conviction, but it's another lens through which to look at the company and potential risks. And I just love that personally.
Sarah, you mentioned headless rounds. Let's talk about that. First, maybe let's get the definition in place to make sure everyone follows, and then we dive into the dynamics.
If you think about historically what pre-seed is, pre-seed tends to be where there is a smart team in place with a bunch of assumptions based on a problem space they found or a problem space they've experienced. Now, nearly always I'm seeing prototypes at first round. That wasn't always the case, but I think with software being so easy to build now. And so inevitably there's a lot of risk and a lot of reward. I think the minute you start to have like design partners, customers, theoretically you could go out and raise a seed if you have a certain kind of profile. And so what I'm seeing more and more is rounds that are sub 1.5 million, let's say, where there is no trad lead in place. And partly this is to do with the check size of small funds creeping up. So like my check size now on average, probably about 250. I think I'm still learning more. Like I like the angel positioning. I think 250, 300K to me feels great. But when you get 3 or 4 of those together, that starts to feel with angels like a round. When I think about a headless round, it tends to be a syndicate of smaller firms coming together. And that could include like even a C camp who, their check size also is quite variable and flexed. In nearly every case of this I've seen, it's when the founder is experienced and confident enough to say, well, we don't necessarily need a lead to trigger the round happening. The founder is confident pricing it themselves and going around to all of the various stakeholders and getting feedback on that. To Anthony's point, the pros and cons are at the next round, it's everybody's job to pick up the phone, which it kind of is anyhow. But I think when there's a lead in place, sometimes you're tempted to be like, okay, the lead will handle the work of kind of making sure all of their friends look at this company. I think the follow-on financing and bridging is actually really important in this landscape right now. especially because it's so hard to, it is really unpredictable to know how much money you need the first round. And if the company has a good fundraise, they're always going to get offered more capital they might need. But if they're not running a public raise, if it's a private raise, they will go out with a set of assumptions. They might just need more time. So I guess for me, a headless round tends to be something where the founder is intentionally choosing not to pursue something that feels more lead-like, aka go to ICs, somebody taking 60% of the round.
I want to add two things that I think they don't contradict each other, but it shows how controversial, like how many two sides of the coin, like of each topic in VC exists. Like is if you, for example, have these microfund rounds and that are headless by design, I think the nervousness is around what I think Sarah also mentioned, which is like, if shit hits the fan, if you need that extension, who will stick their neck out, right? And again, it's theoretical. Maybe someone does, maybe because of the power of the many and their LPs, you stitch together. It's like, I think it hasn't been stress tested in Europe yet too much because I think they're a bit of a new phenomenon. But theoretically speaking, that's what gets me nervous on those. Like there's a lot of pros, that's the cons. Now, the other side of the equation, you get that lead VC, you would think like everything is being done on the next round, which is kind of what, you also said theoretically. Practically, I can say that usually at the next stage, let's say a Series A, whether it's been a seed fund or a series or a multi-stage fund, even more so, I think if it's the latter, I do a lot of the work. And that is not trying to say that I do good work or that I'm trying to take credits for it. It's just, I'm like, you're still the vulnerable place where they can be vulnerable with, right? And so actually the theory of like, no, you get the lead VC and then it's like scalable because you don't have to do too much. Actually, like to the next round, not after that next round, but to that next round, there's so much heavy work to be done, is my experience. And the more it's multi-stage, the more there's a dynamic of like, I'm also pitching to them because they need to double down. And so there's a lot of work to be done there. So trying to contradict on the theory and practice.
Actually, a really important point is there's a supposition the lead picks up the phone, but in reality, all of us know if you are good at working with founders and founders trust you, you're going to be working on that really closely as well.
And they'll work together. Like I'm not discounting the work the lead VC will do. They will really do that, but they will also want to like, the things they're not sure, they want to ask the lead VC, or the things they want to be vulnerable on with you and are they not sure about, they use us, right?
I was at the EBAN Congress. When everyone else went to Superventure, I went to the EBAN Congress. I ran a stage where we designed a program that flew a bit in the face of how many angel investors invest in Europe or in the States, some as well, but in Europe we have a bit more prolific issue with angel investors that come in very concentrated in their portfolio mix and then end up being overly exposed to single assets, and then everything turns sour, especially the relationship once the startup hits the troublesome times that any startup will always go through, because the angel does not like seeing all their money potentially going down the drain, and then they reach back into their private equity background and their toolbox from that time, or their SME ownership times or whatever, and they become maybe less productive in the usual VC sense. So let me then ask you, because in this group, we had a discussion around, or an interesting realization around, how often would an investor be part of a round that is competitive? It was so funny because I brought a group of angels that did 10, 12, 15-ish investments per year, and all are very much embedded in the venture ecosystem. And they all raised their hands when I said, who here, or they all said, well, I was in a competitive round last month, or like I just closed one yesterday. And then the rest of the group, the usual angel, to them it was a completely unknown situation. What would you ever compete to get into a startup? I'd love to ask you here, because you both do, and I bring this up as part of this conversation, of course, because you both do angel rounds. So I'd love to hear this micro VC's take on angel rounds and the competition that exists here, and how to navigate, how you navigate it, how you think about it, and what role competition plays at the angel round stage.
I don't know if that's the right angle to it, but what I would say is that usually the competition in the angel rounds I tend to do is between whether they want to do an angel round or go for a proper institutional round. So like the competition I face is like persuading the founders that in their specific situation, they should do that friends and family angel round with like a microfund or two and angels versus a VC on the times that makes sense. Like maybe it doesn't make sense for a specific company. So I think so the competition, I would say, tends to be even more specifically, if I look at companies that I was going to do an angel round but ended up becoming VC rounds, it systematically has been the founders of the companies they used to be in if they're ex-operators. So it's like they go to the founders and they tell them, no, scrap that. You should raise as much as possible, which is funny because maybe they wouldn't have done that for their own companies. So I don't know if that was like the way you thought about the question, but I find less other angels be the competition because the check sizes and all of that can fit. And it's about crafting. That angel round is about crafting the idea, like since you're diluting a bit to get something that's not going to be about runway and burn and a lot of money, it's going to be about getting a buffer to get you started and value-added people around you. And it's usually a SAFE or an ASA. I think there's flexibility on the check size and getting more people in as long as there's value on that. So I think the competition is less on that specific round once they've decided they want to do that. It's maybe competition is the wrong word. It's more about like, will they do that round versus the other rounds?
I think angels are a really important part of the scene. I'm biased as an ex-angel. Angel investing was my gateway drug into running a fund. I basically got carried away on the side in the weekends and evenings over COVID. I think part of it comes back to kind of access and education. Like I learned about power law. I think I wrote I did about 39 angel investments and 3 or 4 companies in. I learned about power law and was like, oh my God, got to build out a portfolio. And I think particularly in the UK, there is a certain class of angel investor where it's very much more status led and that's fine. But I think at the same time, the best founders will always pick who they want. Like for me, I love to hunt. I have a very particular value add. I over communicate that. The kind of rounds that I work on, like I'm working on a pre-seed right now with a founder that I did the angel round of. And in the angel round, it was just 2 of us. It's quite distinctive. But in the pre-seed round, we've signed with the firms who are amazing. And all the firms and me are working on the perfect list who's in a very particular domain. And so the check size for the angels doesn't matter. It's really about what they can bring. And so in this case, we already have the commitments for the round, but we're going out and hunting for a few particular profiles that we don't have yet. Because so many angels in Europe have become fund managers, I actually keep worrying about the fresh pipeline of angels. I think this is an incredible value add. You want folks that are working in exciting scale-up startups customers that are also doing checks on the side, 5K, 10K, doesn't matter, that can help our companies win. So I actively spend time with angels because I always feel that you never know when you're going to meet a company that needs a particular thing. To me, competition always comes back to how much choice does the founder have? How much intention are they bringing? You never want to have folks on the cap table that are not useful, that aren't going to answer emails, that aren't going to be additive in a particular way. And a lot of that comes back to founders knowing what they need and you as their partner helping them with that, helping them put together the right sort of patchwork of folks. More angels, please, in Europe.
I would caveat it though, because I do think that we have many more angels that could be incredible investors that are not. So I wish we would have a better conversion of people that decide they want to back startups to people that decide that they want to back startups and have realized the power law and have realized how venture actually works, and thus then flip to the right playbook, which then has a bunch of knock-on effects because, as we spoke about before we actually hit record, fund size defines strategy, and thus also as an angel, how do you decide to invest in venture truly affects how you act as an angel as well.
Completely. But I think all of this partly goes back to, as somebody who went from being an operator to running a fund, it's really hard to raise a fund if you don't have a VC track in Europe. I raised 40% of my fund in the US for this reason. I think there's just not the depth in Europe of LPs that buy that operators can become amazing fund managers. So it's a bit of an imaginative leap. I think it's a lot easier to underwrite somebody who's worked at a well-known firm locally because they have the training. I have a firm belief that you can train yourself, especially with my size of firm. You either put in the work or you don't. But I think to your point, there is so much amazing information. The future will not look like the past, but whether it's me reading the generous deep dive into Founders Fund, whether it's going for walks and talks with folks in Europe that have built amazing firm, the information is out there for angels that want it. I think it's more a matter of, like any craft, you have to put time, effort, and work into it. Like you wouldn't expect a founder to build a company overnight. So I think for angels out there who want to convert to become either professional angels or fund managers, all of it goes back to putting the work in, learning, listening, building up your recs. I feel quite strongly about that.
And I think that's also a bit of a prompt of Andreas to say like, hey, Anthony, what have you been doing with Super Angel? It's been a bit busy time, so we'll get back to it. No, but I do. So all that is additive to what's been said, because I agree with all of that. But this basically, I think if there was a way, because new waves of angels, right? And you talked about crafting the best kind of angel syndicate, right? So you have some of those angels that are prolific angels. You have some that are like operators and have immediately peers of theirs that have done it before, so they learn it quite fast. But then you have all these other bucket of angels. Let's say, oh, I'm a company working in procurement and I want to have a few procurement leaders, or, that type of thing where like these people have kind of grown in their organizations to a level where they have some money and they like the innovation. But then like, can you actually get these people educated really fast so that you're getting benefits of both worlds? Because sometimes you get that angel that's like the procurement leader X, but that angel doesn't know that, the moment you do that angel check, you should write it off in your head, or some of those fundamentals, like it's a power law, you need a level of volume as a minimum, and that can become a sour thing as well. And then it's a different equilibrium. It's like dissuading. Imagine that person that put that money into 2 companies, he put too much of their savings, of their bonus of the year, they lost that money, and then all of their peers who could actually be a next wave of angels, he tells them, or she tells them like, hey, don't do it, like you just lose your money. And so it's like such fine line in these other bucket of angels that I somehow, if we can have a way to educate them, and maybe like I'm overstating how many of they are the importance, but I do think on the kind of more is better and more variation is better. I do think there's work to be done, and it would be only a great thing, right?
Yeah, that's really, I was just thinking of a friend in the Netherlands who was super active during ZERP and showed me, but very concentrated, and showed me their losses from that time. And I was very struck by it, of just somebody going very hot in a hot year, putting too much money in. And then, they're left with the supposition that all early stage investing, they will lose money. And I don't believe that is true in the long term. But again, doesn't feel good to be them, I think.
I was just looking here at ChatGPT, hoping that I could find a really quick number, because we spoke about how much the angels, are there enough angel capital, are there not? It baffles me when I look at the Danish ecosystem, and I then get to learn that the Danban group, the Danish Business Angel Group, deployed in 2024 40 million euros. That is a lot of angel capital.
Great.
But it is just deployed not in the way that Anthony described it, so to say, which is why I think that this is where it's one thing, yes, we want more operators from our good success stories to come out and come back to the ecosystem and invest. Absolutely. But I really think that the big vision, or at least my mission, is to bring these already deploying angels into, so to say, normal venture best practices, because that's not where we have them today. 80% of angels never do more than 3 deals. You're bound to lose. No one is successful with that strategy in venture. So I really this is where I'm focusing and why I'm touting it here on the podcast. I want to go to another topic. You gave me a good segue to it a couple of minutes ago, Sarah, and that's the decision to go solo. I'd love to ask you, we started this discussion around the future, so to say, or the dynamics between solo GPs, micro GPs, and then the big players, the multi-stage funds. I'd love to ask you both, tell me, why is it that you choose, or I actually say it this way to all my friends that I hope would become entrepreneurs, I give them a bunch of good arguments why they should become lifestyle entrepreneurs, like I am myself. You have chosen, and all your friends, or at least many of them, are VCs. But a lot of them are also VCs in bigger firms. I'd love to ask you, because I'm sure that you're championing your own model just as I am mine. What are you saying to them? Why are you not saying, why don't you leave that big firm, build your own thing? Why, can you give me the sexy case of being a solo GP?
I have lots of friends at VCs. I also have lots of friends who aren't. I worked as a tech operator for like 20 years before. So I have lots of friends who are like, oh my God, why would you throw away your old salary and go and do this mad thing? In my case, I was really led by the thesis. I've spent my entire career building communities around technical products. I became irrationally obsessed that, moats in technology were dying, which I think I was totally right. It's actually sort of playing out really well right now. I became really obsessed with, what stands around a company. How do you build your moats when technology is easy to build? It really becomes brand, community, trust, all these things I've done for a long time. And a couple of years ago, I was looking at Europe, looking at companies that have got big in this way, whether it's kind of Hugging Face or Supercell or Monzo or Miro, and realizing that no fund had that thematic focus. And I kept thinking, if there was a fund that did that, I would try and join them. And then it kind of clicked in my head one day, this actually is your fund. You have the right to run it. You have the right to do it. I think for my character and my personality and the way that I see the world, I like kind of small scale artisan boutique-led investing. I really believe in the primacy of the founder-investor relationship. Obviously, the maths of returning a small 10 million fund 3x net is a lot easier than a much larger firm. But I also had enough friends, when I was going through the process of deciding to launch Common Magic, I was not 21. I had a lot to learn in terms of investing, but I had an incredibly clear thematic focus. I had an incredibly clear set of angel companies that were all on thesis. And so lots of friends at larger firms were like, okay, you could go in and join a larger firm and get trained in that way, but you would have to pause on the thesis and invest in their way. And I think for me, I felt so strongly about the time is now. I felt so strongly in what I saw in the market. And I felt very strongly that if I didn't capture it now, I would miss the opportunity forever. And so, I didn't particularly, the goal was not go into VC. The goal was launch this firm. And so for anyone thinking about doing a solo fund, I think it appeals to people that are completely entrepreneurial. You're not earning much money. You're working very long hours. You're managing, like as an operator, I love the mix of my work. I've definitely seen friends who come out of larger firms where all they're doing is just sourcing. It's an adjustment. Whereas for me, I think in my old life was managing teams of 70 from kind of Japan to San Francisco. So I was just very used to the kind of the workload was not unusual to me. But I love the personal, the proximity of it, the intimacy of it. Like I've got all my founders on WhatsApp. I've got most of my LPs on WhatsApp. As a long-term community manager, as a long-term stakeholder manager, I really enjoy the relational nature of the work. It's not for everyone, but for me, it's been pretty amazing and beautiful. That's my lemonade stand. I love solo GP life. It's great for me.
Anthony, before we kick it to you to say a few words, and I know you'll say many of the things that Sarah said, I'd love to also challenge you to talk about the dynamics of big firms, the politics of being in a big firm, so on. I like without calling out your past firms, but you have been in big firms, and I know that you're very embedded in the venture space. So I think anyone can realize that what you say here is, of course, considerations across many, many, many firms in Europe.
I'll make it broader, actually, which is, and maybe also talks about the micro side, but in venture, if you think about it, right, it's such a long game, right? So it pays off because I went also like from, one fund to another, right, and changed as well. And I was at the crossroad at some point, and I was asking myself, like, why am I changing like firms, right? Like this is a long game. You should get into one firm, one structure. If you love venture, just be there as long as possible. That's the game, right? But it's really hard because, well, it's evolving beasts. And most of the structures that was before, and I'm not talking about the specific funds, it's just like the dynamic of any fund. How you join might be very different 2-3 years later, right? Of decisions that are being made. I was also junior at the time, right? So like there were other people that are really making decisions and things are morphing daily, right? And so you're called to get into a structure where basically it's a vertically integrated game. So it's a partner specific thing, right? Then there's usually a managing partner that takes decisions that are strategic about a company and a fund, right? A fund as a company, which you might agree or disagree with, right? And then on top of that, you start having coordination costs because you have like basically layers and people and structures. They need to do your work and you need to report to someone on what, on average, again, VC partners tend to suck at being managers or just are not interested into being managers. Why? Because the best venture investors are obsessed about doing great deals and helping their founders, and they see it as an opportunity cost. And so this is biased to you, but I just think it's very rare. It's possible, but it's very rare to find a structure where all these things are ticked, where you're in a structure where, you feel like this is the fund that empowers you to do the deals you want to do, to win the deals you want to do, and to do it in your own terms. And for some people that checks, for some people doesn't. Now, within existing firms, yes, there's politics. I mean, I guess what you're playing for with being in an existing firm is you believe that the team around you the strategy of the fund. So the team around you, you respect, right? And you feel like are additive to you. The fund and firm strategy, you believe, enables you to win your own deals. And it's a structure that enables you to do your own deals. I guess if you get all those things ticked, then it's a great environment to be in. Now, and then you add an element of timeline because things evolve, they change. Funds like hire, change strategies. Now they do seed and they're aggressive. Now they do only growth. Suddenly, they kind of hired a bunch of associates because it was 2020 and they had to be on top of everything. Now they're firing most of them. Then you're left as the only person that used to be junior. That's not. So there's dynamics. And so I think that's hard. Now, at the same time, when it works, it's beautiful, right? Imagine being in a firm where you have 6 complementary partners with amazing experiences, different implicit biases, goods and bads, playing total football with each other, being on top of everything, having more capacity to think through things, to be more strategic about things. That's amazing. It's rare and it's personal as well. So it's not like, hey, I can name you the funds that happens. It's just like, for certain partners, this happens in certain funds. And I think that's fantastic. And this is, by the way, not diplomatic way, just like the way I think about it bottom up, having been through those different kind of phases and firms and funds. To finish off, just to talk about the solo side on my side, I'm not going to add too much because it's really hard to go after what Sarah said because it was amazing. And I mean, of course, I agree with a lot of it. Some of it I don't come as I was an operator in the beginning, but I didn't come at it from an operator point of view into the solo GP. I do think that it's the purest form. So you should start at it as an obsession about a topic, an edge, a strategy, right? It shouldn't be as, I believe I'll do better alone. It's I don't think that's the way to start. It's I'm obsessed about fintech networks. I think that's an edge of me. I think actually it's a huge TAM because increasingly almost any company is utilizing fintech. And I feel I'm prime positioned to capture that. And I'm obsessed and almost irrational about doing the least scalable part of investing, which is just spending time with founders and hoping they're the next decacorns or beyond. By the way, doing that and founding Sarah that actually ticks all those boxes at the same time is super hard. That's, I think, how you start solo. I think that's the way, and that was the way for me as well.
But that's a really interesting question, Anthony. I got pushed on this a lot by LPs about starting solo. And I think to your point, if the right person had been right in front of me and we had absolute trust, we'd Asian invested together, I keep learning how hard it is to build a venture firm and a venture funds. Hiring is really hard, managing time is really hard. And I think what's most interesting to me right now, as I look ahead, is how do all of these small funds evolve in Europe? Clearly some are going to fold. They might do it once or twice and decide not to go again. Maybe it's just not a fit for where they are. I think some are clearly going to merge. I think some are going to scale through AUM. Some are going to double down on exactly what they do best. I think it's very much decentralized in terms of there's no one path. And I think that's quite exciting. It means founders get more choice. I think there's something really interesting about how all these group of small funds starting now evolve over time that is unclear to me so far.
Sarah, Anthony, thank you so much for this closing on the manifesto of the solo GP. I am truly excited about what's happening in Europe. I do think that we are at a absolute crossroads, so to say, both in terms of what's going to happen in Europe, but also in terms of, I think that there's a lot of capital that should go to firms like yours. So thank you to both of you for joining me here on today's podcast.
Thank you. This
was a lot of fun. Thanks for having us.
Before you go, I just want to give a massive shout out to the partners who made the EUVC Summit and Awards possible. So please do not tune out. We're partnered with these firms because they're great people with offerings that we know from our friends in the ecosystem are truly world-class. First up, I want to give a big thanks to HSBC Innovation Banking. They helped us incept the awards in the very beginning, and truly, they are the leading bank for anyone in European venture. There's a reason why everyone knows them. Google Cloud, they were our venue, hosted the summit. What a team, what a big effort they put on to help us. We're hugely grateful. Make sure to reach out to Arabella or Oksana at the Google Cloud team to hear how they can help you as well as your portfolio. Massive credits goes to them. Ace Alternatives, we have so many friends in the Berlin ecosystem partnered with these guys. Just the best fund ops team around. And as with any good restaurant, where the locals are is also where you get the best service. And now they're expanding across Europe, so they're definitely someone to talk to. Hainspoon, they're longtime partners of ours in both our own legal work. They're great supporters of us here at the EUVC, and I definitely think that they are one of the go-to legal teams to have in your corner. CW Communications, our dear friends who helped us secure CNBC, Bloomberg, Financial Times, and many more for the summit. It's a joy working with Dan and Kathy and the team. Fundcraft, digital native, full suite, Lux headquartered, and a great partner as you grow your firm out of Luxembourg. Definitely a fund admin to consider in your stack. I can only say that the team are incredible to work with. I'm very thankful that I've gotten to know them. I think they're one of the up and coming fund admins that you want to be thinking about. Portfolio IQ by Synaptic. You may know them for the Discover tool, which is branded under Synaptic, but Portfolio IQ is absolutely a product you should know because there's no one that understands intelligence better than this team. And finally, Goodwin. They are a truly world-class legal partner you can trust. They're hands-on, business-oriented, and expert in everything and anything transatlantic. So those were our partners for the summit and awards. I know this might have been a bit long and boring, but really, if you have these guys on your side, I don't think your firm could be in any better hands. And also, they're helping us do what we're doing every day for you.